In this video, we're going to talk about the real reason that your stocks are underperforming. And we're making this video because a ton of people are dealing with this, but they don't want to talk about it. In fact, I could say most people are dealing with this. And the reason no one wants to talk about it or admit it is because it feels kind of embarrassing. So check it out. When the market looks like this, and this is the S&P 500 right here, if you feel like your stocks aren't performing at the same level, you think, hey, I must be an idiot. And this happens to me too. You feel stupid when it seems like everything is going up except your stock. But let me tell you right now, you are not stupid. So in this video, we're going to break down this underperformance and what you should do. And this is important because you don't want to do the wrong thing because that will make your performance even worse. Now, the first thing we got to do is talk about what underperformance really is. What does it actually mean? Because we could say that it's making less than what the index is making. So if the S&P 500 is up 5% and you're up only 4%, you could call that underperformance. But as you'll see in a minute here, it's more complicated than that. And another thing to realize is that when we're talking about underperformance, we're not just talking about how our portfolio is doing versus the index. More likely, what a lot of people are talking about when they state underperformance is how they're doing compared to other people. Because guess what, guys? We're human, and humans love to compare themselves to others in their tribe. And this goes back to our genetic makeup from tens of thousands of years ago. But the problem now is that we still have that caveman brain, but now we're surrounded by all this technology, including social media. So when do you feel like you're underperforming the most? Well, it's probably when you jump on Twitter or Reddit and you see all these people posting all their gains. This guy made 100,000 on this meme stock, this other guy made 200,000 on a SPAC, and everyone's constantly posting how great they're doing while you're sitting there with a 3% gain after 3 months. How does that make you feel? Horrible. You definitely think you're underperforming. And I'll tell you what, you and me in this era with social media have it way worse than anyone before us. Because back in the day, people would talk about stocks, but they do it at work or at cocktail parties. But now you're constantly surrounded by it. You got notifications coming to your phone. You're just getting bombarded all day with all these crazy results. So what does it lead to for investors now more than ever? FOMO, the fear of missing out. So when you see all these other people popping off, obviously you feel like, man, did I miss the train? Am I doing something wrong? They're winning and I'm over here losing. And again, it's almost hyper stimulus at this point because of social media. And again, we're defining this stuff because it's important. We got to identify what underperformance actually is, because more than likely we all have a twisted perception of what it is. And this whole thing with FOMO and the social media that we're talking about, it happens in every aspect of life. It's a really human emotion. So the whole concept of keeping up with the Joneses, your neighbor gets a pool, so you got to get a pool. Neighbor gets a new truck, you get a new truck. This happens to everyone. The time when you feel poor or inadequate is when you're comparing to someone else. Even on an absolute basis, if everyone is doing way better because the stock market is going up, we're all doing well, you're still going to feel like you're not doing well if you're comparing to the next guy. And this happens at every level of society. So even the billionaire who has 2 private jets, he's looking at the bigger billionaire who has 4 private jets and thinking, oh man, I suck. So at every level, everyone is comparing to someone else that's doing better than them. So it's a stupid trap that we all fall into. And it absolutely happens in the stock market, and we could classify it under underperformance, or what we think is underperformance. And another thing to realize here, if we pull away from other people and we just compare ourselves to the index. Again, normally if you say you're underperforming the index, then the S&P 100 could be up 5%, you might be up 2%. But there's another important factor to that. Over what time frame are you looking at? Because look at this, when I look at the S&P right now, it's up 0.07%. But my personal portfolio might be down 2% today. So is that underperformance? Yeah, I guess maybe it is if we just look at today. But what if we zoom out a bit and look at a week? Or zoom out even more, look at a month, a year, 5 years? What time frame are you actually looking at when you're saying you're underperforming? We'll talk about that more in a second here. But the reason we're going over all of this is, again, to establish that your idea of underperformance is usually subjective. And the problem with that is that you can cause yourself a lot of pain, especially when you're looking at others. So what do you do if you're trapped in this and you're underperforming? How do you fix it? Well, the first thing you want to do is stop comparing yourself to others, obviously. Here's the thing. When it comes to the stock market, there are a million different ways to invest. Everyone does something different, and people can be extremely successful using the opposite strategy of someone else who is also extremely successful. For example, take a Warren Buffett, who's a value investor. Obviously makes tons of money, right? Well, there's other legendary investors, say like a Stan Druckenmiller, who isn't so focused on value investing. He focuses on trends, buys things that are going up so that he could sell them at a higher price, and he makes billions of dollars too. So if that's the case, then there are so many different ways to play the stock market. So what you got to go back to are, what are your goals when you're in the stock market investing? Because say you're a person who's working towards their retirement. You want a nice nest egg and you want to be able to pay for your kids' college. Well, the way you're going to invest is going to be different from the guy who's on Wall Street Bets and's got $1,000 in the market buying meme stocks hoping to flip it into 100,000. The two strategies are going to be extremely different. And I'm not even saying the Wall Street Bet strategy is worse. I'm just saying it's different. He's playing with $1,000. You're likely playing with your life savings. You don't want to be doing the same thing. And you also can't expect the same results either. And when I say results, you always got to remember that different results come with different levels of risk. So the meme penny stock guy, he might flip $1,000 into $10,000 in a few weeks. Incredible, right? But also there's a very good chance that he completely loses his $1,000 in just a few days. Whereas you, if you're making say 10% a year on that large sum of money, yeah, it's nothing like going from 1,000 to 10,000, but also you likely don't have that downside risk of losing it all. And that's another thing you got to remember when you're comparing yourself to others and others doing different strategies, especially. Most of the time, everyone on social media is just posting their wins. They're not telling you about all the huge losses that they're taking. And this is a very popular thing to do for people who sell trading stuff online. They'll show you results of them taking $1,000 account and bringing it up to 100,000 within a few months, or let's say a year. Seems amazing, right? 100x, this guy must know what he's doing. Well, he sort of does. Now to get from 1,000 to 100,000, yeah, it definitely requires some skill, but it also requires a lot of luck, because to grow your money that fast means you're taking on a ton of risk, and that's a ton of blow up risk. So what happens is that these guys, these gurus, what they actually do is start like 20 different accounts, put $1,000 into each of them, and it's even more than 20 because blowups happen more often than that. And what they do is they play these accounts, right? And most of them blow up, but maybe one, if they're lucky, actually hits that 100,000 goal. And then they show you that one account, but they're not showing you all the other accounts that blew up. And when you measure it all together, the probability of having that account that took off is very low, and it's very dangerous to try and mimic. So again, if you're sitting there comparing yourself to that guy or any of these people on Reddit, you're going to drive yourself crazy, because once again, that's not your goal. You might not have that high risk tolerance. You might be putting your life savings on the line, which most of us are. So you don't want to be playing in that field. So you shouldn't be comparing yourself to that either. You not going 100x in a few months doesn't mean you're underperforming. And this is where psychology in investing becomes so important. You always got to guard yourself, because as soon as you fall into that trap of trying to keep up with everyone else, that's when you do things like buy a car you can't afford, upgrade to a house you can't afford. You screw yourself just in the name of trying to keep up with everyone else. Now, the second thing you got to realize with underperformance is what we were talking about before, time frames. So when we use this example of the S&P being up 0.05% today and my account being down 2%, that does not matter at all to me. If you're going to try and compare yourself to the index day in and day out, thinking you always got to be above it, you're going to drive yourself crazy. What you really should be doing is zooming out and looking at the bigger time frame. So see how your portfolio does against the index on a yearly basis, on a 5-year basis. It's over those longer periods where you could really see, hey, am I actually underperforming? And it gets tricky here because you may underperform the market over a 5-year period, but then you may way outperform it over a 10-year period. But my main point is that if you zoom out, you're going to get a much better perspective than if you're looking at the comparison between the index and your portfolio daily. That's just a stupid thing to do. And again, psychology is important, right? Keeping your emotions in check is important. So that zoom out is going to absolutely help with that. Now, the third thing to realize here, which goes back to how your strategy does over a 5 or 10-year period, is that the market and your strategy will go through cycles. And they're going to be different cycles depending on your strategy. So I'll give you an example. Last year, our Fallible strategy, which I myself and all our Fallible members use, we absolutely crushed the market. Did way, way better than the index. But this year, we are underperforming. We're basically break even at 0 while the market is up like 8 or 10% right now. So what does that mean? Does that mean we suck, that we're doing something wrong? No, it does not. Because when we look at our long-term strategy here, we know what our returns look like. Look, since 2008, it's over 2,100% versus the index, which is only at 700%. You can see the equity curves right here. Our strategy is this blue line, the index is this red line. We do way better over a longer time period. But today, and maybe in these first 5 months of this year, we are absolutely underperforming. But again, that underperformance isn't a bad word to me because I know how my full strategy works, how the cycles work. So I'm not going to stress out because one, I know things could absolutely turn around in the second half of the year where we could way outperform the market. You don't know what's going to happen. And two, even if we do underperform this whole year, I'm once again looking at a 5-year cycle or a 10-year cycle. And I know we come out much better. So that's how I don't stress myself out in the present. Because again, underperformance is going to happen and it's going to depend on what time frame you're looking at and also your own strategy. The strategy that I was just showing you, it's a momentum strategy. It's going to work great in some markets and not so great in other markets. markets. No strategy works incredibly in every single type of market. And for our fallible strategy in those not so great markets, we may go sideways for a bit, or we might only make small gains. Again, it's okay. And this whole thing we're talking about with our strategies brings us to our fourth point, which is don't break your strategy. Because one of the worst things that happen is that people feel like they're underperforming, and then they move away from their strategy and try to do something different to try and increase their gains, right? But really what happens is they end up screwing themselves. So they lose a bunch of money and they're in a worse position than they were before. If they thought they were underperforming before, well, they're definitely underperforming now. So this most commonly happens with people who have a more passive long-term strategy. They say, okay, I'm going to buy these stocks and not look at it for 20 years. Well, when you start getting caught up in Reddit and Twitter, you start thinking, oh my gosh, these guys are crushing me, and whatever I put into the market 5 years ago, that was stupid. I need to change it. And then they start messing with their portfolio, going in, becoming an active investor, trying to mimic what's happening on the internet. And then what happens? You screwed up those investments that you had in there that were the right investments, most likely. You just needed to wait and be patient and not get distracted by all these distractions, which is really what they are. But that's the problem. It can really turn into self-sabotage. So once you understand what underperformance really is, and you understand that you shouldn't be comparing yourself to others, and you should be zooming back to see what your real performance is over a longer time frame, then you realize, yes, I just need to stick to my strategy and not break it. That's going to be the key to long-term success in the market. Now, just in case you did fall into the trap where you broke your strategy and you did take a big loss, we made this video right here on how to recover from losses. And I know all of us have taken big losses in the past. So this video right here is going to be really important to get through those losses and prevent them from happening again. So click here and I will see you in that video.